season is busy, especially if you're a practicing attorney. If you're overwhelmed, you are not alone, which is why we're here with CPA and CEO of Counsel CPAs and Advisors, Emil Abedian, to answer your top tax prep questions.
Thank you so much. Thank you, Jordan. Thank you for having me here today.
Well, let's launch straight into it. So what should law firms look into if they're wanting to hire a CPA?
All right. So it really depends, Jordan, what the partners or the law firm owners are looking for. Now, we sometimes get clients that want to talk to us and just want a tax return file. And if you just, as a law firm owner or any business owner, really just looking for just a tax return to be filed, it's a lot easier to find people that can do that. I think most CPAs can help you just file a tax return. But in my opinion, I think a CPA should provide a lot more than just preparing a tax return for their clients, specifically for a law firm owners and law firm partners, because they're so busy with everything else. As you know, running a firm is not easy. You have to do the billing, you have to do your marketing, you have to handle your IT, you have to take care of your team members. On top of that, you have to serve your client. So having a CPA that really knows what they're doing for your industry, whatever industry you are in, but we are only working for lawyers, obviously, and for law firm partners and law firm owners, I think they should look for a CPA that can provide them more than just tax return preparation. That's my advice. Unless you just want a tax return preparation, then I think H&R Block is perfectly fine. I don't know if that answered your question or not.
Yeah, well, it's one of those things where I want somebody that can specialize in law firms, because at the end of the day, it's my bar card on the line, right? And especially when it comes to law firm finances, I really don't want to mess with that. And I want to make sure I'm doing it properly so that I don't get sanctioned or get a grievance filed against me. So to me, yeah, it's really important that I find a CPA that wants to work with me and that's worked with law firms before, especially. Like kind of getting into that and gearing into it. So should a CPA, if they're, working with law firms and attorneys, should they be familiar with trust accounting?
I think that's given. If you don't do the trust accounting correct, as you know, you could get in trouble with the state bars. So if me as a CPA or an accounting firm work with law firms, I think they should know trust accounting, because that's a big portion of what accounting for law firm means. Yes, you need to do the bookkeeping and tax return preparation from the IRS's perspective, but if you don't do your trust accounting correct, you can get in trouble. So I have a lot of colleagues in the accounting industry, obviously, and we talk a lot. A lot of them are not touching the legal industry because of the trust accounting issues, because of the issues and the responsibilities that comes with it. So yes, to answer your question, I think as an accountant working with law firms, you should know trust accounting really well.
And it's also one of the number one ethical violations of any bar across the country is Rule 1.15, which is the trust account, keeping your property separate and keeping your attorney property separate from your customer property, but also being able to, do things like your trust account reconciliations, things like that. And going into that and really delving more into trust accounts, what are some common issues that you see with attorney trust accounts?
The major number one problem that I see talking to lawyers is, it's a misconception of what trust accounting is. A lot of lawyers, specifically in the contingency kind of firms, where they reconcile their cases. Obviously, the way they do it, money comes in, they spend certain amount on vendors, on cases, and then whatever is left, they split between themselves as a law firm and the client. That's great. They should continue doing that, but that's not trust accounting. That's case reconciliation. A big misconception is that they're done their work and they're okay. And as if the state bar would come in, they would be able to show their case reconciliation and they will be fine. But that's wrong. You need to reconcile your trust account, the IOTA account, transaction by transaction. You need to see or be able to show proof where these transactions went to, who it went to, which case it was for, so that end of the month, when you reconcile your trust account, bank balance trust account to be specific, it has to match your total case-by-case reconciliation. So yes, the case-by-case reconciliation needs to be done, but you're far away from being done with your trust accounting if you're only doing that portion. So that's number one misconception that a lot of lawyers are making. Other things, issues, or kind of common errors, which is not really intentional. It's more just, it just happens because we're so busy. As a lawyer, you're running your operation, as we just discussed here a little bit earlier. You pull up your drawer, you get a request for cutting a check, maybe a rent check, an operational payment. You pull out the wrong drawer and you cut a check from your trust account. 100% accidental. That's not intentional at all. But the state bar doesn't care if it's accidental or not. If you cut a check from a wrong account for the wrong purpose, you can get in trouble. So those are the things that you could put in systems and processes in place to minimize the risk for errors, so that you don't get in trouble. But going back to my first thing, number one issue is the misconception of what trust accounting really is.
And I think part of the problem too, if you're like me and you're a solo or small firm attorney or a boutique law firm and you're trying to do it yourself and you think you're doing it properly, but then about 4 months in, you realize, oh, you made a mistake, 3 months ago, it becomes almost impossible to go back and do it yourself and try to reconcile your accounts and try to do that three-way trust account reconciliation by yourself. Like even I think the State Bar of California, they have new regulations for CTAP. I think even they said, hey, if there's been a mess up and it was in a prior month, go and hire somebody to help, hire an expert to help.
CTAP requires you to reconcile your trust account monthly basis. Mm-hmm. And as soon as you get your bank statements available from the bank. What is that? What does that mean? I think, in my opinion, if you do it within 15 to 20 days following the month, I think you're fine. But, let's say for January, you finish your reconciliation by the 15th of February or even 20th of the February. But if you wait until March or April to reconcile a trust account, it's too late. Per CTAP, California state regulations, it's too late. So you want to do it regularly, definitely. But as you mentioned also, it simplifies your job because you might not remember what happened, what these transactions were for 3, 4, 5, 6 months ago.
Oh, absolutely. I do not. So yeah, definitely. And going from there too. So are you able to audit my trust accounts for compliance risks?
Yes and no, Jordan. And yes, because it's relatively quick for us to look into the numbers and compare certain things to see if it's right or wrong. Mm-hmm. I can do that very quickly. My team probably needs 3-4 hours to kind of get in and kind of dig into the details and see, okay, this is right. But if it's wrong, then we have a problem. It's not easy to just audit trust accounting and figure out what the problem is. We can figure out very quickly that there is a problem, if there is a problem. But in order to find the mistake or the error, that's a lot harder. And that, in my opinion, cannot be done with just a simple audit. The way we do it, if we find mistakes, and this happens a lot nowadays, actually, especially with the California State Bar's new regulations, we get a lot of influx of clients that want us to go back and clean their trust account because they have to sign off that everything is correct relatively soon here. So what we do when there is mistakes, we start with the most recent data and start going backwards, because that's the only way I think you could do it. You can't start from 5 years ago and start coming ahead and coming forward. So we start with the most recent and go backwards, and hopefully the mistake is sooner rather than later. So as soon as we catch it, as soon as we can reconcile it, then we're fine. But if we can't find it, then we got to go back at least 5 years, because that's what this California State Bar, they could do. They could go back and request documents in 5 years from the last disbursement from your trust account. So our recommendations, and also from discussions and advice from ethics attorneys, is that we should go back 5 years unless we find the mistake earlier, obviously.
And also be advised too, for attorneys that are watching who might not know, some state bars will do random audits. So it's not that anything's been flagged, your name just popped up, and they'll do a random audit. So it really does behoove you to have your records in order and be nice and clean about it in order to get through that process as painlessly as possible. But,
as you know, Jordan, regarding that, California is coming up with their random audit procedure very first. It's supposed to be February 1st. I don't know if they will actually start February 1st, but random audits of trust accounts in California is being implemented as of very, very soon. So
yeah, and I do think more bar associations are going to take that same tack. So just be advised that if your bar is not doing it, chances are they will be in the future. So just look out for that.
So
and then,
just a question for you now, Jordan.
Yeah.
Can Smokeball, we work with Smokeball, we have a bunch of clients that use Smokeball and we implement it, but I want to hear from you from the other side of the kind of the equation. Do you think Smokeball helps simplify the trust accounting for us?
Oh yeah, it's part of the reason why I actually joined up with it. So I'm a practicing attorney. I do family law down here in Texas. And so when I started trying to figure out what to do, because I'm now on my own, it was a little bit terrifying. But so then you find practice management software and then you find Smokeball. And so especially when you're looking at three-way trust account reconciliation and what that looks like, right? You're comparing the client ledger, the individual client ledger to your, trust account ledger to your bank statement. And how do you make that easier? And so that was one of the main selling features for me on Smokeball, was because they just make that a whole lot easier. Essentially, you input the number from your bank statement and then they let you check off and you just back it up from there until it equals out. So it's a really super simple, easy way. And then once you do that, you download it. I turn it into a PDF. I download it. I save it to my file, and then I can submit it to the bar. So it just makes it a whole lot easier. So I will say having a CPA is the holy grail. It also just makes things, I feel, a whole lot easier for the CPA and for anybody who's helping you if you have a practice management software where it's easier to be able to track this stuff.
100%. I agree. As I mentioned, we use Smokeball and we do that. I just wanted to hear your perspective out of it. But yeah, having a practice management software simplifies the trust accounting and keeping track of your entire practice significantly. So it's a good idea to invest in one if you as a lawyer don't have one.
Yeah, absolutely. And then moving on down for our questions, because we got a lot today. So what steps can I as a firm owner take to minimize my tax liability?
What steps can you take to minimize your tax liability? That's a very good question. Number one thing that I always tell my clients, or even prospects that come to me, they might not sign up for certain reasons, but planning. You have to plan. Like, saving taxes doesn't happen overnight. Tax planning is not a one-time event and it's done and you can go back to it next year again. In my opinion, the way our firm's approach is, we work with our clients throughout the year to have all the data. First of all, we do the accounting monthly basis to have the data for us to make smart business decisions. Because without the numbers, you're just flying blind. And if you don't have the number, if you can't measure your numbers, there's no way for you to fix something. It's like trying to lose weight without knowing what your weight is right now, and you want to lose weight, but how much weight am I losing? So that's where it starts with. The first initiative, you have the data. And then you do planning throughout the year. Entire year is a planning process. We talk to our clients regularly, monthly basis, if not more often, just to get information from our partners. See, where is the firm going? What are we doing? What is the plan? So we can be involved and also share our insight from our perspective, so that when it comes to maybe October, November, December, we have really good data to base our projections and the planning on, to be able to implement tax strategies to be able to reduce the liabilities by end of the year. If you don't do that, if you come to me, by the way, we don't just do tax return preparation because of this specific reason that I'm going to talk to you about now. If you come to me in January, February, March, ask me to prepare a tax return, which I have no idea what you've done in the prior year, it's not much I can do. I have to take your number and put it into software and just spit out the tax return. 99.99% of CPAs out there can do pretty much the same job. H&R Block could probably do the same job, but you lose the opportunity to plan and potentially save significant amount of taxes by not being involved throughout the year. So that was a long answer to your short question, but planning would be number one thing. Make sure you're involved. You don't have to do it yourself. You can hire a CPA, an accountant, or maybe you know it yourself. You do it yourself as a partner, but make sure you pay attention to it, because if you don't, time flies and tax season is here. You haven't done anything, and there's not much you can do to reduce your liability.
And then, like, when you're talking about planning, because to me, it's almost like goal setting for law firms a little bit, where we goal set for ourselves in our personal lives a lot, right? Especially as the new year happens and we're trying to do resolutions. But I feel like a lot of us as firm owners don't do goal setting for our own firms. And I think that goes hand in hand with having a CPA and doing these monthly check-ins and trying to figure out exactly what I want and how much money I can save and how to do it the most efficient way.
100%. You gotta put goals. You don't have goals. You got to be able to measure and have goals to see where we're going. Other than that, I don't know
But
how.
you see, I think that's part of the problem for law firms, right? And so for lawyers, it's essentially when you're first starting out, your goal is, oh, I just want to keep my head above water and maybe make a little bit of extra money. So we don't really, I think we kind of shoot ourselves in the foot there, where we're not saying, oh, you know what, I'd like to increase my revenue by 20%. I'd like to limit my tax liability so I can save X amount of money. And that's what we should be thinking of it as, right? It is a business at the end of the day.
It's very easy to, as you mentioned, when you start off, say, okay, you know what, I just want to make a little bit more money this year, and then next year, a little bit more next year, just want to keep on improving. It's very easy to just keep on doing things the way we've done it. I've done it myself. I started my practice 15, 16 years ago or so, and I did not think the way I'm thinking today about my practice. I wish I did. I wish I got the advice at that time. I was just doing everything and for everybody and just without really an purpose. Well, purpose was obviously to grow business, but without really targeted goals, and that prolonged my growth significantly.
Yep, same. I completely understand.
Right. We live and learn.
Honestly, yes. But do you have an example of how I can structure my firm for tax efficiency? So, when people are first opening their firms, I think a lot of questions are, oh, should it be an LLC? Should it be an S Corp or an S Corp? So, what does that look like when you have those conversations with your clients?
Yeah. It depends a little bit with which state you are in. For example, I don't know where most of the listeners here would be, but I'm in California. In California, you can run your professional business like CPA firm, law firms, architect, doctors. You can't run it under an LLC. It got to be a corporation if you want to form an entity, or a sole proprietor. So in California, your really options are S Corps, C Corps, and LLPs, unless you want to stay as a sole proprietor, obviously. Mm-hmm. In certain other states, you could be, I think Texas, I need to think, but I think Texas, you could be professional LLC, PLLC. Yes. So you can form an LLC, which is taxed very similarly to an LLP, limited liability partnership, like it's taxed as a partnership. And so it depends on the size of the firm, how many partners are involved. There's benefits with both structures. When I say both, I'm comparing partnership and corporations, and partnerships fall under LLCs and LLPs fall under partnerships, and S Corps is the S Corp formation or the structure. And there are benefits with both. The partnership structure gives a lot more flexibility. So if you're an LLP or an LLC in certain states and you have multiple partners, the benefit with that is that you can allocate profits as long as you want, as long as all the partners agree on. So let's say you and me are partners, Jordan, and we do business this year. We made $2 million, but you did all the work. I took time off and spent time with my family this year. It's not fair for us to split the profit based on our agreement. So in a partnership structure, you could take all of the profit this year and I could take nothing. Whereas in a corporation, you cannot do that. You have to split the distributions of the profit distributions based on your ownership. In the company. So that's one benefit the partnership has. But S corporations have other benefits. There's more tax benefits in S corporation than there is in a partnership structure, because number one, you have the S corp Social Security savings that you can make from S corporations. But again, it depends on what size you are. If you're making $3 million, the S corp Medicare saving or a Social Security savings is not going to be much, because you're required as an officer and a shareholder of your S corporation to take a reasonable salary from your company. But without getting too much into detail, what we do, this is not a good fit for everybody, and this is not an advice right now, but a typical structure that we can implement for our law firms or multi-partner law firms is that we put an LLP in the top in California. It could be an LLC somewhere else. And then the owners of the LLP or the LLC are two S corporations, assuming there are two partners.
Yeah.
So you put an S corp in between the LLP or the LLC and the owners. That gives you both kind of the perfect combination. You get the the flexible structure entity from the partnership. At the same time, you can get the tax savings from the S corporation. So
Did not know that was a thing.
Yeah, I like that structure because you can play with it a little bit more, and you can still take advantage of the tax benefits.
That's awesome. Wow. Thank you. And
but that's not good for everybody. Obviously, if you're
right.
solo owner, then we got to look and see, okay, what's maybe just an S corporation is enough because it's only you and you don't need the flexibility that a partnership would need. So,
yeah, exactly.
But the multi-partner firm, that's typically a good structure to do.
Now, with regard to tax elections, when should attorneys consider changing those?
When you mean tax elections, you mean from going from a sole proprietor to an entity? Is that?
Mm-hmm.
Typically, I would like to start off correctly from the beginning. If the goal is to grow a firm and run it as a business, I would do it from the beginning. There's no need for you to really wait and incorporate later on, unless you want to just keep it small. Even in the future, the goal is not to grow a business. The goal is just to have a well-paid employment that nobody can bug you, and you do whatever you want. And in those cases, I think sole proprietorships are perfectly fine, even until up to $150,000 in revenue. It's not much. Well, maybe not that much, but maybe $60,000-$70,000 in revenue, you're still okay running it as a sole proprietor. But anything more than that, the tax savings from incorporating will be more than the headache of having an entity. So obviously, running it as a corporation or an LLC, there are some requirements you have to follow. The annual minutes for corporations, the annual filing requirements, which sole proprietors don't have. But in my opinion, if the goal is to grow a business and not just have a well-paid employment for yourself, I would do it from the beginning. Just do it right. Just move on.
Are there any routine items that attorneys just forget to deduct?
Routine items that attorneys forget to deduct. One major thing, I don't know if you're familiar with the PTE, pass-through entity tax. It's a fantastic tax deduction, was implemented in 2021, and it's going all the way to 2025. So unless it gets extended, this is the last year you can take advantage of it. And it's fantastic deduction because you can pay a big portion of your state taxes. Doesn't apply to you because you don't have state taxes in Texas, but California and New York, they're high state income, high taxes for those states is making a big impact. For California, for example, just as an example, a firm with $1 million in profit can pay $93,000 of their personal taxes, which usually would not be a deduction for you as a partner on your individual return. You could pay that from your entity. And when you pay that from your entity, that will get you deduction from your entity level. And the $93,000 would probably save you $35,000, $36,000 in taxes. Wow. Just by paying a tax from the right side of the pocket. Right. You got to pay that tax anyways. You might as well do it right and pay from the entity and get a deduction. That's a major thing that a lot of firms in the recent years are missing. And what it is, it's not only California. There's 36 states that have implemented that tax code. Other things that lawyers can miss, just low-hanging fruit. If you have kids, for example, you're paying them anyways, right? I have kids. My oldest one is actually turning 12 today. It's his birthday today. So I'm going to take off right after this and go have some fun with him. But he's coming to the office and he's doing some work for me. Nothing major. He does some shredding. He goes to, takes care of the mail, makes some coffee. What we do, we pay him some small salary. I need to pay him anyways. I need to pay him for all of his personal expenses. Why not pay him as an employee and take advantage of it? We can deduct it on the corporate books. He can earn up to about $14,000 a year without paying taxes on it. So that's a double benefit from both sides, from tax perspective. But in my opinion, a lot more important kind of lesson here is that he's learning how to deal with money. At the early age, you're teaching your kids how to see money, how to value money. Now he's making his own money for the shoes he's buying or whatever he's buying. and he's thinking twice before he buys those shoes because he earned that money. So I think that's a good lesson that we can share with us, that it's not only tax benefits, but you can teach your kids a significant amount of financial education that I don't think any school would teach them.
And then in that same vein, are there any items that attorneys maybe deduct too aggressively? Like, I remember there was an article that came out, I think last week. There was an attorney that was trying to deduct a race car because he sponsored it for his firm, I think, but he was also trying to deduct everything related to the car, as in the purchase price of the car and everything else related to it. And I think the court finally said no. So I'm just wondering if you've seen anything like that where maybe you have clients that are trying to do that and it's a red flag and you say, hey, you can't do that.
You would be surprised. You would be surprised how many creative ideas I get from clients. What if I do this? What if I do that? What if I do this? First of all, you don't need to do anything creative. There's enough with proper planning. From what we discussed a little bit earlier here, you do proper planning. There are enough of strategies you can implement in a legal way under the radar without creating any red flag to reduce your tax liability. That's number one that I always share with my clients. But crazy idea is it's a personal injury law firm who was trying. They were trying to take this Tesla case to court. So they bought this Tesla not as a car expense in the business, because they already had cars for their partners, and not as a marketing expense either, like in your case, but as a research and development cost. We're buying this car to break it down to see what issues it can cause and how we can attack those kind of issues in the courtroom. To be frank, I don't see any problem with that, unless they don't really do what they're telling us to do. If they don't tear it apart and they start using it on the streets and just driving it, then that's obviously illegal. But if they buy it for research and development, they tear it apart and they use it actually for that purpose, I don't see any problem with that. But that was pretty creative idea, and it was not my idea. It came from the client, and I thought it was pretty creative.
I think so too. That's wild. All right. And then last question here, because we're at our 10th question. But can you help me plan for the financial impact of hiring additional attorneys or staff? So we talked about goals, and maybe I want to try to hopefully expand in the next year, but I don't really know how to go about that or how to start, especially from a financial perspective. So is that something that you routinely help attorneys out with?
100%. And I think that's very important for lawyers to really look into, law firm partners to look into before they start hiring, because it starts with your numbers. How are your numbers today? What do we have? Because if you don't have the numbers and you're flying blind, there's no way you can do that. We start with the numbers. We put the current numbers in place. Okay, this is the data we have. And then we compare that to projections. Where are we going? What's your plans? Projections are always projections, obviously, and we don't know exactly if they will happen or not, but at least we get an idea of what our goal is and what we think the numbers will look like 6 to 12 months from now. And then we compare those two to see where is the gap. What do we need to do today to go from current data, current situation to where we want to be 6 to 12 months? Does that mean that we need a couple of more attorneys, or even just one attorney, or maybe just a paralegal, or maybe just someone offshore? Not necessarily, because a lot of law firms that we work with, and we work with solo and small law firms. We don't work with 1,000 attorney firms. Typically it's anywhere from sole proprietors to 100 employee firms. And a lot of them, what I've seen, is starting to offshore to the Philippines or wherever, multiple countries. And that's a cost saving. But yes, to go back to your question, definitely that's something we help our clients with, comparing our current data, comparing our projections, and then discuss with our clients what needs to be done. I can't make a decision because I'm not into the business daily basis, even though we're talking to our clients pretty often. But I think it's important for law firm partners to involve their CPA in that discussion to make sure they don't overhire, or on the opposite, also underhire, because that's a dangerous also, because you won't be able to grow in the form you need to.
Right. You just kind of remain drowning, which I think a lot of attorneys can identify with. Well, then a little bit of bonus content there going along that same line, but how can I best prepare for tax season throughout the year?
Again, I don't want to repeat myself, but going back, if you've done your homework throughout the year, if you've done your planning, if you have your records, when it comes to tax season, everything is ready. But when we work with our clients, tax season is a breeze for us because we already have the numbers. We already did a projection in October or November or December, somewhere there. So the client is aware of roughly what the final result will end up being. So there's no surprises in February, March, or April when they get a big tax bill because they've been prepared for it for the past 3, 4, 5, 6 months. So the best way is to really plan and get involved and do your work, not only the trust accounting, that's a must by the state bar, but your regular accounting for IRS's purpose is not a must to do monthly basis, but I would strongly recommend you to do that so you're aware of where you're going, you know exactly what the number is going to look like. So when it comes for tax season, you know there's no surprises. It's already there. All you need to do is basically scan in the bank documents, the mortgage interest, and property tax statements and all that, and send it over to your accountant, which is, I don't know, 30 minutes of job probably at the max from the taxpayer's perspective. So be prepared throughout the year. That will save you significant amount of not only time, but significant amount of money and headache, because you don't want a tax bill of $50,000, $60,000, $70,000 a week before the tax deadline from your CPA. That you would not be happy with that CPA.
I would have a panic attack. But
Yeah.
so in an ideal world, I would want to be meeting with my CPA once a month just to check in, make sure that everything is happening as it should. Is that right?
Exactly. It's sometimes even more often. So we talk to our clients. So the way we work with our clients, we do the books monthly. We send final financial statements to clients every month. We have scheduled meetings with our clients on a quarterly basis. But that doesn't mean that we just talk to our clients quarterly basis. And it's unlimited correspondence with our team. You can reach out to us anytime you want, which opens up an open communication. So we talk to our clients probably, if not weekly, 2 or 3 times a month.
That's speaking my language because I need hand holding. So that's very good for me. Well, thank you so much to Emil for being here and, just for answering all of my questions, especially if you are solo small and you're really just trying to get into running your firm. This is one of those things that you have to pay attention to. This is probably the most important thing that you have to pay attention to is your law firm finances. So I really appreciate it. I think a lot of times attorneys, again, we just don't know what we don't know. And a lot of times we kind of ignore what we don't know and stick our head in the sand, especially about finances. But this is so, so important. And this is going to affect your firm's legacy and its longevity, hopefully for years and decades to come.
I agree, Jordan. Well said. Thank you so much. Thank you for having me.